Hi, this is Mike Lembeck with Remax Commercial bringing you today's Let's Talk About It. Today we've got three articles, mostly on interest rates and what the expected interest rate increases are going to be in the next couple of Fed meetings, and maybe potentially a third meeting now is projected for this year. So let's get started. All right, our first article is titled Goldman Sachs, Bank of America expect three more U.S. rate hikes this year. So as I stated in the introduction, we've got three more rate hikes. We had anticipated earlier this year or late last year that would only be two, but now it's anticipated to be three, with the current inflation rate at 6.4% and not the past interest rate increases, as significant as they have not had much of an effect on our overall inflation rate. So they're going to ramp it up potentially to a half a point increase, and I even saw some mention of another 3/4 of a point increase in the next Fed meeting. So let's take some look at some further information in the article. It's saying there, Goldman Sachs and Bank of America said they expect the U.S. Federal Reserve to raise interest rates three more times this year, lifting their estimates after data pointed to persistent inflation and a resilient labor market. So we've got both persistent inflation, and the labor market is just, hasn't had much of an effect on slowing down the hiring. A lot of jobs available, unemployment is down, so that's looking good for the economy, but they're anticipating to have to increase the rates more in order to offset that and get down to their target rate of 2%. Also in the article, in light of stronger growth and firmer inflation news, we are adding a 25 basis points rate hike in June to our Fed forecast for a peak funds rate of 5.25% to 5.5%. So it's looking like that's where they're going to be settling at least at this point. Now, potentially, if the next increases don't have the effect, obviously they may make some adjustments in those. Also in the article, it stated Bank of America research, or global research, also expects a 25 basis point hike in the Fed's June meeting, pushing the terminal rate up to 5.25 to 5.5% range. It had earlier penciled in two rate hikes of 25 basis points earlier, each in the March and May meetings. So there you have it again. It's stating that we're anticipating that interest rate increase to be in effect of 25 basis points. Again, might be up to half a basis point, or even 0.75. Also in the article, it states that a majority of economists polled by Reuters before the latest data said they expected the Fed to raise rates at least twice more in the coming months, with the risk of them going higher still. None of them are expecting a rate cut this year. So there was talk last year that sometime this year in 2023, as we move through the year and the rate hikes had their effect, that we might potentially have interest rates going down. Now it doesn't look like it. It looks like we're going to be having increases throughout the year. My guess is that they're going to have to do more than just three interest rate increases if they go with the 25 basis point increases. We'll have to see what effect those have on the economy and inflation, and see if they have to bump them up to the higher half point or 3/4 of a point increases in the Fed meetings. All right, our next article is Fannie Mae sees Fed pursuing higher for longer interest rates policy. So this article is basically validating exactly what the previous article said, and kind of the same information. It goes on to say the recent blowout labor report and unexpected robustness in retail sales and manufacturing output don't mean a reduced likelihood of a recession, the Fannie Mae Economic and Strategic Research Group said Tuesday. The group continues to expect the economy to fall into a modest recession, and now believes the likely start date will be the second quarter of 2023. So we're coming up to that start of that second quarter here probably pretty rapidly over the next month or so, with what we've got left in February and then March. So then we'll be into that second quarter and anticipated recession starting then, even though I think most people feel that we are already in a recession with the utility cost increasing, grocery costs, gas costs, everything's just increasing, and just we're feeling the pinch anywhere and everywhere. So I don't see it. I don't know how they're coming up with a forecast of it starting in second quarter of 2023, except for if they redefine the actual recession, the definition of a recession is, and it's constantly being moved on what it actually is. So hard to say when and where that's going to start. Also in the article it says recent data have been stronger than expected in ways that we believe are likely to lead to tighter monetary policy with attendant increases in interest rates. So again, more information on the interest rates going up. So just be ready for it. All right, next article is a map where home prices are dropping the most, and in this map we're showing different locations throughout the United States, what areas are feeling how home prices are dropping the most. And as we see here, we've got San Diego at 8.6% and Los Angeles at 7.6%, and then also Riverside County at 6.8%. So the majority of the Southern California counties or area have all been dropping anywhere from 6 to 8% roughly, and this is over just recently over the last year. So we anticipate those price decreases to continue. The article, it states that overvalued markets will see the sharpest declines. After mortgage rates surged to nearly 7% last year, home price growth began to slump across the country. As of December 2022, home prices had registered their sixth consecutive monthly decline, and Black Knight predicts those decreases will likely extend through 2023. So any signs of a recovery in prices looks like that's not going to happen in 2023. We're going to see further declines in the real estate market as far as values go. Some areas will be, worse off than others. Some areas will actually hold their value more. This typically in most recessions has been along the coastal areas where most of the demand is present, with even tenants wishing to live near the ocean, near the beach, and then also with homeowners purchasing their new properties closer to the ocean, if of course they can afford it, because that market is going to be of course higher priced than some of the inland areas. So hopefully you found this information useful, and if you have any questions on anything, on what the market's doing, what values are, what the property value of your building might be, if you're interested in selling, doing a 1031 exchange, maybe repositioning your portfolio with some value add. We're also getting into the syndication market with purchasing some larger complexes to as a joint venture type of scenario. So if you're interested in hearing anything about that, feel free to reach out to me and give me a call, and I can tell you what type of properties we're looking at. So again, hopefully you found this information useful. Make sure you like the video and subscribe, and so you don't miss any of the forthcoming ones that I'm going to be doing in the future. And just hopefully everything works out with our economy and things start to recover faster than what we're anticipating. And so look forward to hearing from you. Have a great day. Thanks.